It's important to understand, even on a day-to-day basis, what's happening in global markets and what the key issues are. But then in a more medium-term sense, it gives us a very good indication about the likely trends in our own economy. So I'm going to start by looking at some of these international issues. I'm going to spend a fair bit of time on them because I've found over the last 6 or 9 months that invariably many of the questions that I get at functions such as these, individual meetings with clients, are about international issues and how they might impinge on Australia. So I'll spend some time on that. And then just some key things about thinking about where Australia's going. Particularly I want to talk about the mining boom, where we're at and how to think about it. That term's a very catch-all term, but we actually need to think about that in a number of layers. So I want to talk about that, and I'll finish up by talking about interest rates and the exchange rate, and then hopefully I'll be all done by about 1:45, and we'll have time for questions for both Caroline and I. So to start with, looking at the international economy, I guess the key issue here remains what's happening in Europe and European sovereign debt. The table on the right-hand side of this slide you can see in these screens shows you the levels of sovereign debt as a percent of GDP, and of course you see some of the key countries in Europe, such as Greece, with very, very high levels of sovereign debt. You can also see there high levels of sovereign debt for most countries across Europe. The real focus at the moment, by the way, is actually on Spain, because Spain is an economy that is probably doing just about as badly as Greece, but it's a much larger economy than Greece is. So if there are problems in Spain, that's going to cause much larger problems for the Eurozone in reality than is the case for Greece. Now, the issue that Spain has had is that increasingly people have thought that the chances are that its government's not going to be able to fund itself. What that really means is that they're going to need a bailout package from the rest of the countries in the Eurozone. Just recently, we've had a very important thing happen, though, and that certainly soothed the nerves of investors all around the world. That important thing was that the European Central Bank suddenly changed the goalposts. It said that they were going to actually contemplate going into the bond markets of countries that are in trouble. And this was clearly pointed at Spain and Italy, countries that are in trouble, and that they would buy the bonds of those countries in those markets. Now, the reason for doing that is to stop the yields on those countries' bonds rising to unsustainable levels. Now, the European Central Bank, of course, has a mighty big bazooka, because what it can do is that on the left-hand side of its balance sheet, it can print cash, and it can use that cash to buy the bonds of the countries that are under pressure in their markets. So in that way, they stand in the market against the speculators. Now, they haven't said that they'll protect a particular level of interest rates in these countries, but they certainly have indicated that they're prepared to stand in those markets and stop the yields getting too high. And I think that's really had a huge influence and made a sea change in investors' attitudes to Europe. Really what this means is that investors now think the chances of the Eurozone breaking up are much lower. And you can see that in the chart I've put together for you here. The red line on this chart, is the yield on German government bonds. Now, that's not a spelling mistake. That's what they call their bonds, right? So German government bonds, and this is the yield down the side. And at the moment, the yield on German government bonds is about 0. Now, that means that investors have been buying those bonds as a safe haven. They've bought them to the point where they're not even going to get any interest on those bonds, but at least they won't lose their money. They're fearful if they lend their money to Spain or to Italy that they'll lose their money, so they've been buying German government bonds. Now, the other two lines on this chart represent the spread of the yield on Spanish government and Italian government bonds relative to those German ones. So this is reading off this right-hand side of the scale. And there you can see that at one point, Spanish government bonds, the yield on them got right up to about 7%, or 700 basis points above those German government bonds, which are the low risk ones. Then along came the European Central Bank in July and said, hang on a minute, we'll go and buy these bonds. And look what's happened to those spreads. They've come all the way down to below 3%, nearly 2% for Italy, and also for Spain they've come back to sort of 300 to 350 basis points. So in a nutshell, I think this shows us just how important this has been in terms of investors' sentiment about Europe. And I think that's actually probably a reasonable assumption to make. Right now, the market is worried about whether or not Spain will actually apply for a line of credit that it needs to do. In other words, it's going to have some oversight over its government funding. If it does that, it gets access to this European Central Bank bond buying program, which, by the way, so far hasn't been activated. And I think that is another interesting aspect of this. Even though they haven't done anything, the mere threat that they will has changed investor sentiment quite dramatically. But the bottom line for me is that whilst we will see ongoing uncertainty, risk in Europe for a long time, that sort of catastrophic risk of the European currency zone breaking up has basically been thwarted by the European Central Bank's action. Now, when we're thinking about Australia, to bring this back home to Australia a little, I guess the first place that I start is where do all Australia's exports go? And what you can see on this chart is recent data on the distribution of Australia's exports by markets. And, you know, no surprises here. You can see that China is the largest one, Japan's the second largest, South Korea, European Union 8%, but that does include the UK. So the UK is 3% of that 8. So only about 5% of our exports go to Europe, continental Europe. So actually it doesn't matter that much if that economy is pretty weak directly. Not many of our exports go there. There is quite a number in this other column, in this other part of the pie here, of countries in Asia. You add all the Asian countries up, 75% of Australia's exports go into Asia. So Asia's the key for us. Asia's the key for us. And I guess the good news is that the outlook for Asia, I think, is very positive. And I was listening to Caroline's speech and she was talking about the potential for growth in exports of coal from Newcastle. And I think that potential is very, very large. You kind of listen to the news these days and sometimes you hear journalists talking as if the growth and the expansion of Asia is already almost over. And that's complete and utter nonsense. There is a huge amount of upside left in Asia and there are many ways to demonstrate that. But the way I think about it is that the key drivers of Asian growth are, number one, population growth. And for some of the countries in Asia, that population growth is starting to level out for sure. But for some of them, there's quite a long way to go. Southeast Asia, for example, it's quite likely that their populations keep growing. So it's this little chart down here on the right. Their populations keep growing right out to 2040, 2050. So that population growth is a key driver of Asian growth, and that's got some way to run for the region as a whole. The second thing is productivity. Now, again, a word that Caroline used, and productivity is important. And at the moment, most Asian labour is working in what I'd call fairly low productivity industries. And that means there's lots and lots of upside for development of more advanced technologies and so on, or not actually development of them in Asia, just adopting them from the West. That will raise productivity across Asia. That'll boost their growth as well. And as Asia's people become employed in better paying jobs and so on, and more of them actually have paid jobs, just remember there's 700 million Chinese subsistence farmers today, so there's a lot of them have never had paid work ever. As they get paid work, their living standards rise. So that's the third driver, and that's a really important driver. In a lot of ways, I think Newcastle is very lucky in the fact that it's got an excellent university here, and that's not because I went to it quite a long time ago, but it is recognised as a very strong and technically oriented university. The growth in living standards across Asia will mean a number of things. One of them is as living standards rise, populations demand better quality protein. Which country's got a comparative advantage in the region of producing farm protein? Answer, Australia. How about what happens to households as they get more income? What do they want for their children? Better education. Which country has a very strong presence in the region in education? Australia. Which country has a good health system? Top of the world's health professionals? Australia. So I think over time we'll see export of more services than mining and energy to Asia. But that's a 2020, sort of 2030 proposition. So I guess my key point here is that the medium-term outlook for Asia, I think, will provide almost boundless opportunities for Australia if we take them. But what about the next couple of years? I guess most of us are more interested in the next couple of years and what's going to happen and not. And the answer there is that there's no doubt now that the slowdown in the developed world, so particularly Europe, which is currently in recession, particularly in the UK, currently in recession, and in America, which is currently growing slowly, there's no doubt that that weak growth in the major regions of the world is leading to a reduction in exports, or in export growth, I should say. So most of these numbers are still positive, although you can see here that exports to Europe from China have actually gone into negative territory out the end here, this red line, but most of them are still positive, but it's very weak. And that slowdown in exports has definitely slowed down the Chinese economy. Now, we think that China's economy will rebound because they're already using monetary policy to stimulate their economy. We also think that when the leadership issues are sorted out, at the moment they're very distracted by the change of leadership. We think there'll be a fiscal policy boost again, and that will push their economic growth back up to around about 8%. Today in China, we're going to get fresh GDP figures for the third quarter. We're looking for a growth number around about 7.4%. That'll be slightly down on 7.6%. So it's still growing strongly, but it's quite a lot lower than the average growth rate we've seen. We think it'll bottom out in that range, 7 to 7.5%. And by this time next year, it'll be re-accelerating again. But it's definitely true, there's a soft spot in Asia's growth at the moment. Now, turning to America, the world's largest economy, the key thing about America is not so much that it's slipping back into recession. It's just that the pace of growth there remains very weak, even though now they're a long way into the upturn. As you can see here, actually the US jobs market started generating growth from around about the middle of 2010. And since then, we've seen pretty persistent ups in the private sector jobs, but the unemployment rate did come down. But look, as you can see out the end there, the unemployment rate is still hovering just around about 8%. So that unemployment rate has not been falling as fast as the Fed would like to see it. The Federal Reserve has a dual mandate, both inflation and keeping employment in America down to levels which are pretty much near normal. So the message, I guess, for the Federal Reserve is you've got to accelerate the economy. So the Federal Reserve has just come along in the last month and said, we're going to embark on yet another round of quantitative easing, and that quantitative easing will be designed to accelerate the pace of growth and get that unemployment rate down. And until we see that, we're going to keep this program. So they're spending $40 billion US dollars a month on extra bond purchases out of the market, effectively spraying cash all around the economy. Now, you'll hear plenty of people saying that another round of quantitative easing won't work. I don't know why they say that. I mean, it's obvious to me it's already working. Two of the key transmission mechanisms for monetary policy in most economies are via the stock market and via the exchange rate. This shows you the Standard & Poor's, the broad measure of the US stock market. What do we see from July when the Fed started saying, oh, we might do some more quantitative easing? The stock market's a lot higher today than it was back here in July. What's happened to the US dollar? This is an index of the US dollar. The US dollar is a lot lower. So the lower US dollar boosts American exports and helps to protect their import competing parts of their economy. So overall, the answer is that quantitative easing is already showing up in the transmission mechanisms. It'll take a while longer before we see it in firmer numbers for real activity, although we are starting to see some very encouraging numbers on the housing market in the US, particularly in house building. It's looking like it's being rekindled now. So there are some signs that that acceleration will occur, and that's good news for the world economy. So our forecasts for the outlook for the global economy are a soft patch here for China, but a rebound to a more subdued than average pace of growth, but still a good one in terms of Australia's exports to China. The US gradually accelerating, Europe in a terrible recession, and looking a little bit better, but still very weak next year. And there's a table which sort of compares those forecasts for you. Now, looking at the Australian economy, it's also true that we're going through a bit of a soft patch here. You can see that from this chart which shows you our NAB business conditions indexes. And these conditions indexes are published both monthly and also on a quarterly basis. So the little thin line here shows you the monthly reads, more volatile, and the thicker line is the quarterly numbers. So we're actually releasing new quarterly numbers for the third quarter today. But you can see from the pattern of these numbers at the end here, these monthly numbers, you can see these monthly numbers are drifting below that 3% line there. So that means really the economy is growing only at about 2.75%, a little below the long run trend. At the same time, the inflation rate's very low. You can see on this chart the Reserve Bank's two inflation target range bands. So it's from 2% to 3%. That's their only target. Here's inflation at the moment sitting at about 2. Bottom line is the outlook for inflation for Australia looks pretty good, which has given the Reserve Bank room to cut interest rates, and I'll come back to that in a moment. Of everything I show you today, I think this is the most important slide. So this is some recent work that we've done, which is about the outlook for the mining sector and the progression of the mining boom. So I'm going to spend a little bit of time talking about this. And I guess the way that we think about the mining boom is that it's not just a sort of a single thing where it takes off, goes forever and then falls down. There's actually 3 phases in the mining boom, which is what I've tried to illustrate in this sort of rather complicated chart here. So phase 1 is really the rise in commodity prices. You can see that in the stronger terms of trade through here. And that rise in commodity prices boosts national income and activity across the economy. It also it's an indication of strong demand for the underlying commodities. So as that demand rises, producers find they're hitting capacity constraints. They need to build more capacity in order to service that increase in demand, and that's the investment stage. So at the moment we're in the middle of that investment stage. As Caroline said, that investment stage has still got maybe a year and a half to run. It's hard to pick exactly when it'll happen, but certainly in the last 6 months or so, from that peak in the investment stage being right out there somewhere beyond the horizon, it's coming into view now. And it's that coming into view of the peak in the investment part of the mining boom, which is starting to worry the Reserve Bank and policymakers more generally. In phase 3, you see the fruits of the labour and the investment, if you like. So in phase 3, what happens is that you start to see the increased production and the exports from that investment that's gone in, and of course that also boosts the income in the economy and so on, and it offsets the downturn which inevitably will come in investment. So here in this middle panel you can see investment as a percent of GDP, so that's the share. It looks like peaking now at, say, at about 8.5% of GDP and coming down. So there's a little bit to run before we get into phase 3 in terms of investment. Down here you can see the Australian dollar. So as the incomes rise and export prices rise, the Australian dollar also rises, and it generally will peak at about the same time as the investment phase peaks and then start to come down. Now that currency is a very, very important part of the overall picture. The rise in the currency reflects the strong commodity markets. It means that as the currency rises, it allocates resources efficiently into the mining investment phase, and that in turn leads to good outcomes across the economy generally. But then as we start to see that peak go through, the currency starts to slide, and the fall in the currency will mean that other parts of the economy can pick up the slack as the investment boom in mining peaks. But as it turns out, the other parts of the economy are quite weak. In fact, house building in Australia is incredibly weak right now, despite the fact that we are starting to see some increases in prices. That's worrying the policymakers at the central bank for a couple of reasons. One is because we know that there's a dwindling supply of housing in Australia. We're not building enough houses. But number two, as the construction workers start to be put off in the investment phase of mining, a natural place for them is in house building. Right now, there won't be any jobs for them. Also manufacturing, in our business survey, quite weak. Retailing, significant employer, quite weak as well. And against that backdrop, we've got an Australian dollar which actually hasn't done in phase 2 of the mining boom what it should do, which is start to fall. In fact, I looked this morning and the Australian dollar sitting at 103.80-ish at the moment. That's a very strong currency. That's a currency that will be worrying the Reserve Bank, because that strong currency is putting the brakes on the rest of the economy outside of mining. And so far, I've exaggerated this, of course, by picking the iron ore price, which has fallen more. But as you can see, the Australian dollar really hasn't, and it's actually popped up a little bit here again recently. So the currency's not doing the right thing in terms of the outlook for the economy. Along comes the Reserve Bank. So the Reserve Bank is not silly enough to think that they're going to offset the high currency by cutting interest rates or intervening in the currency market. But what they can do, rather than get the currency down, is that they can reduce the negative effect of it by lower interest rates. So by cutting interest rates, what they're able to do is, what they hope to do is stimulate activity in housing, in the retail sector, in manufacturing, and in other parts of the economy that will benefit from lower interest rates, and in that way take up some of the slack ahead. So we think that the RBA is looking out into the second half of 2013 as that mining boom peaks, and they're trying to stimulate the economy out there by cutting interest rates now. That means to us that there's another one coming. So once they cut interest rates in October, I think it was very likely they'd do another increase in interest rates, another decrease in interest rates unless something happened. We think there's another one coming in November. If it's not November, it may be December. Something goes wrong, they might wait until February. But we think there's another one coming. Most likely they do one in November, then they sit on their hands. They like to go on holidays like everyone over the summer, so they will have done their work for the year, go away over the summer, come back in February, see how things look now. Risk is that they might need to do some more, but a lot can happen. The currency can come down, commodity markets could start to rebound, China could have a big stimulus package, who knows? So we think the risk is that there is one or two more out there after a November cut, so that will take the cash rate down to 3%. But the bottom line is we're not certain there will be any more. So in our forecast, we've just got exchange rates flatlining. Now, I'm going to run through these very quickly in the interest of time, so I've got some time left for questions. But very quickly, at the moment, the market is pricing about 100 basis points rate cuts from here. We think one, maybe two, 100 basis points, that's an outlier. So that means that the underlying swap rates, which a fixed rate loan would be priced off, are incredibly low. 3 and 5 year swap rates today are at or below the cash rate. That means if you've got any borrowing that's floating, it's a really good time to look at those variable rate borrowings and look and see whether it suits you to fix them, because these are historically low rates. If you're thinking about that, you should go and see Natalie and some of her colleagues. There's a plug for our local business bankers. The second thing is that the rate on term deposits is coming down, which is not good for self-funded superannuation retirees or people that want to make some money for their retirement or whatever. So term deposits coming down. And again, I'll give NAB a bit of a plug. We're at the forefront of issuing retail bonds, which will give you a better yield these days, but still preserve your capital. And I think people are looking at that. So that's the downside of the Reserve Bank's rate cuts. Finally, on the currency. The currency's being held up by Australia's incredibly good credit position. Look, this chart is very hard to see, I know. There's too much information on it. So just quickly, what you can see here are 7 countries that still have a AAA credit rating. We call those countries the Magnificent Seven. Australia is one of those countries. If you want to invest your money in the bond markets of the governments of those countries, in Australia you can get 2.7, in Norway you can get 1.3, or you can give it to the Swiss government and they'll give you nothing back for it. They'll just take your money. Right? So lots of international investors have been piling into the Australian government bond market, and in turn that's pushed the currency above its fair value. So the 2 red lines on this chart show you the currency's fair value. You can see from around about the middle of 2011, it's been tracking above fair value. Today, it's probably back down, or given the rise that I've just talked about overnight, it's probably tracking above this fair value range again right now. It's a little overvalued. That's what's worrying the Reserve Bank. When we look at the outlook, we still see a high currency. Sure, drifting back down into the mid-90s by the time we get out here into the end of 2013, but still a relatively high currency. And I think it's that high currency at the moment which is causing some headaches for policymakers. Here's the last table of our forecast, so you can see we do have the detail there if you want to get more information on that. And last but not least, I've got to show you this message from our lawyers. which says Rob's tried really hard here, but he doesn't have a crystal ball, so if all this doesn't come to pass, please don't blame the bank. So having said that, I might just leave you with this table. Thank you all very much for your attention.
Bob?
Thanks, Wedge. One for Rob. We're going to be moving into silly season at the federal government level, obviously, and this whole issue about debt, which you've just highlighted, your very first slide, which showed our debt as a percentage of GDP being very low, and then you've had that more recent slide about the actual amount of government debt being very low as well. But there's also the level of private debt in that picture, and the governments are very good at complicating that whole thing to make it tell us, particularly we're hearing at a federal level at the moment, that we've got big problems, but what you've shown to me this morning sort of indicates that perhaps we haven't. How much of an issue do you believe that's going to be, and is it really an issue, or is where we are with debt still giving us an enormous amount of scope to do things to stimulate our economy if we have to?
Yeah, look, I guess the quick answer is I do think we have room to stimulate our economy if we have to, and that's because the truth is that, you know, despite all the politics around it, now we are one of only 7 countries left with a AAA credit rating. That in itself means that we do have that capacity, I think. Having said that, you don't get to keep that AAA credit rating by making silly policy mistakes. And I think actually, you know, with the balance that you have to strike, I think we should be running surpluses already. We should have run a surplus last year. I think actually the government's been tardy in withdrawing the fiscal stimulus. They've left it there for too long. They've now drawn a line in the sand and said we are going to get there this year. And I think from a broad sort of medium-term perspective, that's the right thing to do, because it will continue to convince international investors that Australia is a very stable, well-governed, you know, whichever side of politics is there, economy with great institutions that you can rely on, which means that we'll get continuing access to capital markets overseas. That's important for us because we have more investment opportunities than we do have domestic savings. So we need that capital inflow. So it's important that we do preserve that, you know, preserve that faith, if you like, with the international investment community. So, look, I mean, it will be a bit of a break in the economy when there's already some slowdown there. It's clear to me that the Treasury is actually saying, look, if we're running tighter fiscal policy, that can be offset by looser monetary policy. That's not ideal to me, because I'd like to see the two arms of policy working in the same direction rather than one going one way and one going the other. But, you know, from a medium-term fiscal perspective, I think the Treasury is probably doing the right thing.
Yeah. Peter.
Thanks, Rob. Given our massive underspend in infrastructure, which is a particular issue around the Hunter here, you know, long term, and trying to manage the future growth, how are we going to manage that spend if we continue to drive for a surplus in the national economy?
Another great question. And look, I've got to be honest and say there's more infrastructure work going on in Newcastle, the Hunter region, than practically any other region in the country. So you people have been very lucky from that perspective, and that's, you know, that's also fair enough. You know, Caroline's slide about the strength of exports out of Newcastle, 90% of Australia's coal. That's huge, and therefore it's important to invest in that infrastructure to keep that, you know, very important part of our economy growing. Look, I think the answer is that for whatever reason, state governments around the country have been very poor managers of their fiscal finances over the last decade, and now we've got governments trying to repair them, and that means lots of heartburn for their populaces, and it's a tough job, and I don't envy the politicians at the moment trying to tighten fiscal policy. The answer has to be public-private partnerships. I can't see there being any room fiscally in the next half a decade in Australia for substantial directly funded infrastructure, as much as I think it probably makes sense because our interest rates are low for Commonwealth government borrowing, so you can borrow at a low rate and invest in infrastructure which should then pay back society, you know, many times in terms of returns. So from an overall perspective it makes sense, but from a sort of political economy perspective, from a keeping the faith fiscally perspective, I know it's going to be hard, and I think the solution is we need more public-private partnerships, as hard as they are to work as well. But at least I think that's where the source of the funding might come from.
Thanks. Thanks, Rob. Other questions? Perhaps I could just take you a bit further on Bob's earlier question about household debt, Rob, in terms of when we're just looking at the Reserve Bank figures showing that household debt to disposable incomes are about 150%, which is quite significant in a national context, comparing it to the US and others. And does that, in a sense, provide a cap on the level of borrowings, particularly the household sector, and so the effect of interest rates cuts doesn't have as big an impact as perhaps it would have done 10 years ago or so?
Yeah, thanks, Wes, and I think that is an interesting point. I mean, the way I look at it, I keep looking at the household savings ratio, which you'll know peaked at about 12% of GDP. It's currently running at about 9 to 10% of GDP. So it has come down, but it's still fairly high, and that's the household sector deleveraging. I think it's important to understand how we got here. I mean, it's true that there has been a big build-up in household debt, but that really was a reaction to the deregulation of the financial sector, which then provided lots of innovative products and low interest rate loans for people, or lower. Bank margins were squeezed, and fair enough too. As much as it hurt the bottom line for NAB, the margins were squeezed, and that was a good thing for the consumer. Consumers loaded up in debt, they invested it in housing. In the main, it's paid off handsomely. So that was actually a good investment. Now we've got no more deregulation of the financial sector. It's already pretty deregulated. If anything, it's being re-regulated. So that means that that adjustment is over. So now households are deleveraging. They're getting their balance sheets down to better levels. And from a community-wide perspective, I think that's a good thing. But what it does tend to mean is that there are less consumer dollars to compete for. That's one of the reasons why it's pretty tough in retailing. And I think that, and also there are more things to spend it on than we had 20 years ago, of course, particularly services, internet services, iPhones, iPads and so on, right? All these things that all the young people are carrying around with them all the time, and even some of us oldies are carrying them around now, right? So that's money we spent somewhere else before, and I think that will just mean that you've got to be a very, very good retailer to survive in the medium term in Australia.
Thanks, Rob. Any other questions? Kim's there with the mic.
I thought there must be a burning question out there that someone wants to tell us where we're going wrong here.
Yep, sure.
You spoke about the investment in mining going through the cycles, and in the second cycle, the investment seemed to peak out in 2014. As a lender, does that mean that our miners that are going to invest in infrastructure are going to be dealt favourably by the banks?
Are going to be
dealt favourably? Are they going to still continue to lend for major infrastructure spending?
That's a really interesting question. The really sad thing for the banks, and you can have a bit of a giggle about this, but the really sad thing for the banks are that not much of the investment in mining and energy is being funded by the banks. The great majority of it is being funded from cash flow, from retained earnings, and from direct investment in the companies doing the investment. BHP just did a huge bond issuance all by itself. It doesn't need the banks to borrow the money. So it borrowed the money under its own name. And that's actually one of the reasons why credit growth in Australia has been subpar compared to an economy that's been running at sort of 2.5% to 3.5% for a while. Credit growth in Australia is very weak because the key driver of the expansion of the economy has been that mining investment, but the miners don't need the banks. So, look, I think, the banks just treat every investment proposition that comes along on its merits. They look at the collateral that people can put up for, the cash flow that will support it, and so on. So I don't think that'll change. And credit metrics go up and down depending on where we are in the cycle and the outlook and so on. But I can't see that changing anytime soon, for sure.
Thanks, Rob. Well, it's about 4 minutes to, so probably time for one or two more questions if you have any. If not, happy to bring it to a conclusion. And with that, I can't see anything burning around the room there, Rob, so you've obviously answered everybody's questions. So I think we can all get prepared for Christmas, knowing what what's going to be looking for us in 2013. Can you join with me in again thanking both Caroline and Rob for their presentations this morning?